Welcome back. Once again, this is Joe Basso Sr. with FFL Citadel. And this week we're going to do something where I wanted to do just a real brief refresher course. What I think happens sometimes is if you're a new agent coming in, you've been diligent, thankfully, and you've taken the time to go through the course, and you've gotten through it, and you've passed successfully. Congratulations. And now you're getting contracted and you're going through all of the preliminaries. But you're going to get into the field, and sometimes we just need a little refresher, a little reminder to get us back to square one again, so that when we start hearing these terms, we're familiar with them. So here at FFL, we do two primary kinds of sales. We do mortgage protection or final expense. Everything we do is simplified issue. Say, well, what is simplified issue? Simplified issue is not fully underwritten, which means fully underwritten is someone with a medical certificate goes and does blood and urine, and then that's taken and analyzed, and those fully underwritten policies do not have living benefits, and they don't pay us out nearly as much commission as simplified issue. What's great about simplified issue is, especially with Americo, you can get instant in-home approvals, which is huge. And we'll talk more about that in a moment. So some things you need to know about mortgage protection. Let's just start with that. Mortgage protection is always written with a term product. Years ago, when my parents bought their first house, when they sat at the settlement table, they were offered a mortgage protection plan, which was a decreasing term, which meant every month the face value decreased and it matched the mortgage. I'm not going to go much into detail about that, but what you need to know if you're a new agent is this: mortgage protection is a term policy. What's the difference between a term policy right here and a whole life policy right here? Other than we use them for different kinds of sales, a term product is based on two things. And you can see I drew a little clock. It's based upon time and money. In other words, a client that you're sitting with can choose a term period from 10 to 30 years, depending on which carrier you're going to use. So the time would be the term period, 10, 15, 20, 25, or 30 years. The money is anywhere between $25,000 to $250,000 with Americo if you're a new agent, and $25,000 up to $300,000 with Mutual of Omaha. Say, but can I go over that? You can, but we strongly recommend that you do not, because if you go over the $250,000 with Americo, you're going to need to have a mouth swab done, and it's just much more complicated, and it takes a lot more time, and it's going to bog you down as a new agent. So if you would just take our initial recommendations to heart when you're starting out, it's just going to make it a lot more simpler for you, and it'll streamline you and getting you more sales, more income, so that you can get find success much more quickly. So $25,000 to $250,000 with Americo, $25,300 with Mutual of Omaha are two primary carriers for mortgage protection. So just so you know, term product is a little bit more challenging, a little bit more difficult to qualify through underwriting than whole life. Always remember that. So, and I'm sure I covered this in other videos, but you as the new agent need to realize that when you get into the house and you take out your binder and you're going through your financial inventory sheet, you're going to have some knockout questions there. They're related to their health. And so if a person has had a heart attack, they're not going to qualify. If they've had cancer, especially within the last 10 years, even though it's treated and they're cancer-free, they're not going to qualify for term products. So you need to know what the qualifiers are. And if you're a new agent, the best news you could hear is call your upline. You're in a house. You're going to go through the financial inventory sheet. You're going to call your upline, whether it's me, Joanne, Joe, or whoever else is on the team, or Tyler, Karen. It doesn't matter. You're going to call your upline, and you're going to explain to them what you're in the house for, whether it's a mortgage protection appointment or final expense appointment, and you're going to let them know your client's health, and then we're going to help you land on the right policy. So let's just for a moment continue talking about mortgage protection. It's a term policy. It has a time element and it has a money element. Okay? 3 primary carriers that we use for term mortgage protection products. The Americo Company. There's a Term 100, which is, whether you pick one at a time, let's just say for this example, the client has a 30-year mortgage, so you pick 30 years for a face value of $250,000. If at any time within the 30 years the client passes away, their beneficiary gets 100% of the $250,000. If you select and write the Term 125, this has a 25% accidental death rider on it, which means if they died by way of accidental death, if they just died by natural causes, it pays out the $250,000. If the client died by way of accidental death, it'll pay out the $250,000 plus 25%. CBO is cashback offer. 100 means if they select that, then at the end of the term, at the end of 30 years, they've outlived their policy. Congratulations. Your policy is now over because your mortgage is paid. Everybody's happy. You have the policy. You outlived it. With the CBO 100, you get 100% of your premiums returned back to you in a check. CBO 50 is 50%. 4 of these carry living benefits. Living benefits are something I'll go into in another video. I'm just giving you some basic lexicon terms and policy information, kind of just a review. If you're in the Mutual of Omaha app, please be sure that you select the TLE, which stands for Term Life Express. Do not choose the Term Life Answers. That's the fully underwritten. You don't want to choose that. You're going to choose the TLE. If you're American Amicable, you're going to choose the Home Protector. And this is important. If you're selling in New Jersey, if this is your home state, then American Amicable does not write in New Jersey. Their sister company, Occidental, does. And for term, we could only write the Home Protector. So if you're in our state of New Jersey, you got to realize you got Americo, you got Mutual of Omaha, and you got the Occidental Home Protector. So term products, time and money, and we use those for mortgage protection. Simplified issue, no blood, no urine, and a little bit more challenging to qualify for. They have higher standards for qualifying. Final expense. What is a final expense policy? More often than not, this is a client who's probably middle age or older, and they're looking to put something in place for burial expenses, maybe a luncheon, and then perhaps leave a little bit behind to their children, grandchildren, what have you. Something in the form of a legacy. What is a whole life product? Well, a whole life product is a policy that starts at the individual's attained age and is designed to cover the rest of their life. So they normally go up to age 100 years of age, 100 years old. That's what so in other words, from the time you get it for the whole of your life, that's what they're designed to do. They're a bit easier to qualify for. They do have lower face amounts when you're doing simplified issue with the carriers we have. So you're not going to be able to write them up to 200 or 300,000. They're going to, the face amounts will be somewhere between $30,000 and $50,000, depending on the carrier. And I'll just name a few of those, and then I'll keep this video nice and short. The policy that Americo uses is Eagle Premier. And you can write this policy with any of your clients between the ages of 50 and 85. If they're 49, they don't qualify. If they're 86, they don't qualify. They have to be between the ages of 50 and 85, and it maxes out at $30,000. I will, and again, in another video, go over the riders and all that stuff, and I'll break these products down a little bit more specifically. Mutual of Omaha, there's something called the Living Promise. The age is the same. If they're between 50 and 85, they could potentially qualify for that product, and that goes from $5,000 to $40,000, maxes out at $40,000. And then we have our third carrier, which is not that we only have three, we have many of them. But you should be familiar with this Aetna Ascendo product. And this is used for a few reasons. You may sit with somebody looking for final expense coverage who has had cancer, heart attack, stents, maybe some bypass surgery, and they're not going to qualify for any term product, but they're not yet 50 years of age. Aetna Ascendo rates from age 40 to 89. You may sit with somebody who's 86 years old. You're not going to be able to get them the Eagle Premier or the Living Promise because they're 86. It doesn't write after 85. So if you're dealing with clients that are younger than 50, between from 40 to age 89, they could potentially qualify for this. And the other reason why we use Aetna Ascendo is because it has no build chart. And again, in another video, I'll go over some of that stuff with you. But this is just a basic, simple refresher course to get you familiar with the term simplified issue as opposed to fully underwritten. No blood, no urine, simplified issue. Either they qualify or they do not. We have mortgage protection, which is a term product. The term is for a specified time or term and for a specified amount. These are level term. That means that the premium they're paying will never go up and the term will never go down. So there's no monkey business here. If it's a 30-year term for $250,000 for $100 a month, that premium will stay the same every month for the next 30 years. And then, of course, you have the products here. Hopefully, you just get out a piece of paper, freeze the video, and you can take all this down. Whole life, from the attained age, which is anywhere, depending on the carrier, from 40 to age 89. And that is designed to go, that means they're going to pay up to age 100, okay? This builds cash value. That means that every time they make a payment, a portion of that payment goes into a cash account, an escrow account with their name on it. That's their money. They own it. Term product, there is no cash value to this. There is a cash value with this. It's a whole life product used for final expense. And again, easier to qualify. Somebody has a heart attack 3 years ago, and maybe they had a stent put in, and they're now healthy. They can qualify for one of these products. They had cancer, either surgery, treatment. They're 2 years out of treatment. They can qualify for one of these products. They won't qualify for term. They will qualify for this. So, mortgage protection, final expense. Get familiar with the terms, and we'll give you more detail in further videos.